Hi, I'm David Schenck. I'm an attorney and enrolled agent, enrolled to practice before the IRS, and I talk about tax issues, estate planning, and asset protection. Today we're going to talk about setting up an IRS installment agreement. If you owe more in taxes than you can pay right now, the IRS will often allow you to pay on an installment agreement. They would much rather have the money over time than not at all. And while you're paying on an installment agreement, the IRS is going to cease all levies and garnishments and other collections activities. However, any IRS liens that have been filed are going to remain in effect until you pay off the complete installment plan. Or you get the lien released some other way. I have a complete video on IRS liens. And the 10-year statute of limitations is going to continue to run while you're paying an installment agreement. And the IRS generally is not going to agree to an installment agreement that goes beyond the statute of limitations, although generally is not always, and sometimes they will. For most taxpayers, an IRS installment agreement is pretty easy to set up. In fact, if you owe $10,000 or less, and you can pay it off, including interest and penalties, which are going to continue to accrue, in 3 years or less, then you qualify for an automatically approved plan. If you owe between $10,000 and $25,000, it's not quite an automatic approval. You're going to have to demonstrate to the IRS that you're paying as much as you can. And this means you're going to need to provide them with some financial information. But they're going to let you have up to 72 months, 6 years, to pay it off. That longer time period isn't always a good thing, since interest and penalties will continue to accrue. And if your balance is between $25,000 and $50,000, the IRS is going to want to know even more about your finances. And you'll have to complete a form, the 9465FS, which is different from the 9465. And this is going to require you to disclose to the IRS details about your family, your income, and your expenses. If you owe less than $50,000 in total, you can usually apply for an installment agreement online at irs.gov/OPA, online payment agreement. It's quicker and cheaper online. Cheaper in that the fee that the IRS charges to set up the installment agreement is lower online. Not cheaper in that your payments are going to be lower. The payments are the same. And yes, they charge a fee to set up the agreement. If you owe more than $50,000, the IRS is going to want even more details about your financial situation. They're going to want you to fill out a different form, the 433A, which is a more detailed examination of your assets, income, expenses, and other financial and legal information. And the IRS is going to have some thoughts about how quickly they think you can afford to pay off the debt, how much they think you can afford to pay each month. An installment agreement is one of the simpler IRS debt resolution processes. The IRS is usually pretty easy to work with on an installment agreement because they're going to be getting 100% of the debt plus interest and penalties. And this is important. Generally, the IRS is not going to agree to an installment agreement that pays less than the full amount of the debt, including penalties and interest. But sometimes you can get an installment agreement for less than 100%. It's not common, but it is possible. If you're approaching the end of the 10-year statute of limitations on collections, you may be allowed to set up an installment agreement that will only pay a part of your tax debt. However, this is going to require an evaluation of your equity and assets to determine if they can be used to pay your debt, or if it would be in the best interest of the government to simply seize the assets Complete utilization of the equity is not always required, but they're going to want something. And sometimes they want all of it. Also, one thing to note, the IRS is going to require that you be current on all tax filings before they will evaluate an installment plan. They want to know how much you owe before working out an agreement. If you fail to comply with the terms of the agreement once it's agreed, or if the IRS discovers that you provided inaccurate information, the IRS may propose to terminate the agreement. If they do, they're going to send you a letter and they're going to give you 30 days to comply. Obviously, if you default, you're going to be open to a resumption of collection activities, and there does seem to be a tendency for them to levy defaulters more aggressively. Disclaimer: this video and any accompanying text is for informational purposes only. The information provided does not and is not intended to constitute legal advice. No attorney-client or similar relationship is formed. If you require legal advice, please contact an attorney or other legal professional. This video covers a complex legal area in just a few minutes, and of necessity leaves out much of the detail. Don't make decisions based only on this video.